Before I begin to this video, let me give a quick disclaimer. I am not a financial advisor. The content of my videos represents my personal opinions and is provided for informational and entertainment purposes only. My information is not intended to be legal, financial, or an investment advice. Always conduct your own research and due diligence before making any financial decisions. Remember, it's your money. Please make informed decisions that are right for you. I'll never ask you for money, nor will I provide my phone number or personal email address. If you encounter any suspicious accounts or messages claiming to be me, please report them immediately as fake or scam accounts. Hey everyone, welcome back to the channel. This week was packed with key economic data and market moving events that shaped investor sentiment. Let's start unpacking them all. We saw a mixed signal from the US economy, strong consumer spending, but a weaker than expected jobs report, with 151k jobs added last month and unemployment ticking up to 4.1%. Inflation trends were encouraging, with core CPI rising at its slowest pace since 2021. However, the Federal Reserve decided to hold rates steady, keeping markets on the edge about their next move. Globally, growth concerns resurfaced, with the OECD warning of slow economic momentum. Meanwhile, volatility spiked as the S&P 500 entered correction territory, reacting to news tariffs from President Trump on imports from Canada, Mexico, China, and the EU, raising fears of higher prices and weaker growth. With all this uncertainty, how did the markets hold up? Let's break it all down into this market recap. Following a pullback or a major correction, similar to the events that we've observed within the last few weeks, new participants into the market or new retail traders are quick to jump back into the market, believing that the correction is over. In today's technical analysis class, we're going to go through market internals to gauge the breadth and the strength of the market. Let's take a look at the five major indices or instruments that we can use to actually gauge the strength of the market, starting with the S&P 500 percentage of stocks above the 50-day moving average, the VIX, which is a form of volatility index, the equity pull to call ratio, the US 10-year Treasury yield, the TLT, which is an ETF for tracking the long-term US Treasury bonds, and for my viewers from Nigeria, we can use the 10/20 EMA on the weekly chart to evaluate the market breadth by superimposing these moving averages on either the ASI or the NGX 30 index. Let's get to the charts next to see how each of these indicators or markers work. Now let's take a quick look at how these instruments can be used to evaluate the market breadth on TradingView. First up, the S&P 500 percentage of stocks above the 50-day moving average, which is the S5FI. Let's just type it again together so that you can see how I arrived at it. See, I just put S5 and then I can see the S&P 500 stocks above the 50-day average. You can also get the stocks above the 200 and also the stocks above the 20-day. Well, our interest is the stocks above the 50-day average. And typically this tells you that from the 500 stocks that comprise the S&P 500, what percentage of them are above it. I have highlighted this 50% mark here, which typically tells you that 50% of those stocks are above the 50-day moving average and 50% are below. You can currently see that from around 19th of March, which is actually around the period where the market topped before we've been experiencing these reversals. You can see that that's when we had a shift. You can see when that's when you can see that there became a change. It's an inflection point, and this curve or this line chart has issued a downward slope, and we can also see that it's reached another minima here, another inflection point, and where the curve has started to move up. Now what I want us to take away from this is that when you have a high percentage of stocks within the S&P 500 trading below the 50-day moving average, then you have a high probability that the stock or the ETF you buy is going to go down. So ideally, you'd like to take long positions when at least this value is greater than 40, at least to have a 40% probability that the equity or stock you bought is going to go up. Currently, it's at 33.2, signaling that the market breadth is weak. Now, by definition, If fewer than 30% of the stocks are above the 50-day moving average, we say the market breadth is weak. While a reading above 70, which is somewhere here, suggests broad market participation in the uptrend. So like we said, at 33.2, this is close to oversold territory, which is the 30% region, suggesting that markets are under pressure. The next marker or index we like to understand is the VIX, which is a volatility measure of the S&P 500. Now, what I've done here is to identify this line here, this region called the 20 value. Typically, it is being recognized by traders that when the VIX is above 20, it shows market fear. There is fear in the market. And this is when most investors or traders go risk off. So they stay away of risk assets. Currently, we can say that this value is at 19.27. And this is a decline from around 28 earlier this March. And I guess this spike in the VIX was due to the uncertainty with regards to President Trump's tariff. Now, this decrease in VIX that we've experienced within the last 2 weeks suggests significant decrease in market volatility and fear, which is great for market participants. But remember, so this means that the short-term risk sentiment is improving, meaning traders are becoming less fearful. However, what I want you to know is that once we see the VIX beginning to rise again, it indicates uncertainty and a risk-off sentiment. The next instrument we are going to look at is something called the CPC. So for the CPC, we have the total put to call ratio, we have the equity put to call ratio, and we also have the index put to call ratio. Our focus is going to be the equity put to call ratio. So when I put that on the chart here, this equity put to call ratio focuses only on stock options, making it a more accurate gauge for investors about sentiment around equities. Currently, it is reading 0.67, suggesting a moderate to slightly bullish sentiment. A ratio above 1, as you can tell by the definition, puts over call ratio, signals increased demand for put options, meaning investors are hedging against downside risk. While when the CPC is below 0.7, it suggests excessive bullishness. This tells us that traders are currently optimistic. Now, at the current value of 0.67, we can say that traders are slightly optimistic about the market. So to recap, once you have a CPC greater than 0.7, or I would say from 1, it typically means that you have more puts than calls in the market, meaning there is a bearish cloud surrounding the market. And around this period is when the market actually shows a bottom. Conversely, when the CPC is below 0.5, it implies that there are more calls than puts, and the cloud surrounding the market is bullish, and this has most times marked a potential market top. The next asset that we are going to look at to try to understand is what is called the US 10-year Treasury. So if we put that on the chart here, we can see it here, US 10Y, which is the United States 10-year government bond yield. Currently, it's reading 4.25, and what you can see is that this yield has been increasing from early March. Typically, rising yields often indicate expectations of higher inflation or tighter Fed policy, which typically pressures equities. Conversely, falling yields suggest a shift towards risk-off sentiment. If yields continue to climb like they are, growth stocks may continue to struggle. However, we are hoping for lower yields as that can provide some relief to the market. Lastly, we're going to look at TLT, which is an ETF that tracks the long-term US Treasury bonds. As you can also see again, TLT has been rising, which typically signals a shift or a flight to safety, especially when equities have been struggling like they have been doing since February. Lastly, for my viewers in Nigeria, we're going to use something called, we're going to use the indexes in Nigeria, for example, the ASI. To be able to capture the market breadth, we are going to, let's change this back to the candlestick that we are familiar with. for this session, and we're going to go to the weekly chart. And what we want to see is how the 10-week and the 20 week and the 20 EMA superimpose on this chart. So I'll move to my moving averages here. This is my moving averages. And what I want to see is how the 10 and 20 EMA behave. So I'm going to turn off all the other EMAs that I'm not using. I'm going to give this my usual color. Just enjoy using this. And this is it. You can, so the idea is that you want to see the shorter EMA above the longer EMA, and you want to see if from a market that is trending, and you want to see a consistent like spread between both moving averages. So you can see that within this period from here, the market was a large percentage of the stocks were actually contributing to this uptrend. Within this area here, you can see that this is like a form of consolidation, and currently right now you can see that even though the shorter EMA is above the longer EMA, you can actually see some kind of roll over of the shorter EMA showing this pullback. So to be able to see how the market is behaving, you need to, I recommend you put an emphasis on these indicators. What you are watching for is a cross below of the shorter one below the larger EMA, showing you some form of loss that the market breadth is weakening. We can also do the same for the NGX 30, which is a basket of the 30 biggest or market capitalized stock in the Nigerian market. You can also see how the 10 has been trending above the 20 EMA, and currently we can also see that rollover. We can also look at that for the VOO. Let's see how that is, which is S&P 500. We can also see how the market has been trending from sometime in October, and currently we are seeing that the market is about to cross, if not even cross below the shorter EMA has crossed below the longer EMA. So this is telling you or showing you that the market breadth has weakened. Yeah, so this brings me to the end of this session, the market internals. I hope you've learned something, and I hope you're able to take this markers or these indicators to make your decision. So something I typically do is, for instance, for the US market, I have 5 decision makers, from the S5FI to the VIX to the CPC to the ES10Y and to the TLT. Whenever, what I do is I typically mark a 1 or 0 based on the technicals or the theory I have explained earlier. Looking at the current US market, we have a 40% probability that the market is going to be bullish. So that tells you that you have a higher probability that the market is bearish. Thank you, and I see you in the next section. Let's commence our market performance summary with the US large cap stocks tracked by the ETF VTWO, which recorded a week-to-date change of positive 0.54%. Year-to-date, VTWO has delivered negative 3.44%. The short-term bias on the daily time frame exhibits a bearish trend, while the mid-term outlook on the weekly chart shows the absence of any trend. The Nasdaq, represented by the ETF QQQ, this week saw a change of positive 0.26%, bringing its year-to-date performance to negative 5.94%. The daily time frame exhibits a bearish trend in the short term, while the week chart indicates the absence of a trend. US small cap stocks, measured by VTWO, this week posted a move of 0.78%, bringing its year-to-date performance to negative 7.55%. The short-term outlook on the daily time frame indicates a bearish trend, while the mid-term outlook on the weekly chart is neutral. Canadian equities, tracked by the ETF BCN, printed a weekly change of positive 0.85, also bringing its year-to-date performance to positive 1.03%. The short-term trend on the daily time frame is neutral, while the mid-term outlook on the weekly chart is also neutral. The Nigerian stocks, tracked by the index ASI, this week posted a change of negative 0.94%. Year-to-date, ASI has delivered a return of positive 1.98%. The short-term outlook on the daily chart points to a slightly bearish trend, while the mid-term outlook on the weekly chart indicates a bullish trend. Oil commodity, tracked by the ETF USO, recorded a performance of positive 1.11 this week, bringing its year-to-date performance to negative 2.33%. The short-term outlook on the daily chart is neutral, while the mid-term outlook on the weekly chart is also neutral. Finally, Bitcoin, tracked by GBTC, posted a change of positive 1.21% this week. Year to date, GBTC has delivered a performance of negative 10.40%. The short-term outlook on the daily time frame is neutral, and the mid-term outlook on the weekly chart is bearish. Now, what are my thoughts going into the new week? This week, the markets were flashing cautious signs, with US large caps, Nasdaq, and the small caps all showing short-term bearish trends, while remaining neutral in the midterm. The Canadian market is holding steady with a neutral outlook across both time frames, while Nigeria stands out with a slightly bearish short-term trend but a bullish midterm outlook. Oil remains in a neutral zone, and Bitcoin, while stable in the short term, continues its midterm downtrend. Overall, it's a market where patience and selective positioning matters. Are you staying defensive or looking for opportunities? Please let me know in the comments. Don't forget to like, subscribe, and I'll see you in the next update.